This is a lecture from Open Tuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
There are several fairly small things in this chapter. We've already dealt with capital rationing. The next one is something completely separate. It's replacement. And what it relates to, let me give you a little example. Many companies provide cars to their employees. Cars obviously don't last forever, and so periodically the car will need replacing. And what's fairly common is to have a standard policy and rather wait until the car sort of stops working completely and then buy a new one. They have a policy saying, oh, we'll replace all the cars every 3 years or every 4 years. We'll have a standard policy. And the reason being that, you see, the longer you keep a car, or the same applies to machines, to anything, obviously the longer you keep a car, there are two problems. One is the servicing, the maintenance costs are likely to get higher as it gets older. You know, in the first year or two, maybe servicing repairs are free, guarantee. But as it gets older, it needs more repairs and costs more to run. And at the same time, the older the car is, when you do come to sell it and replace it with a new one, the sale value will fall. So keeping a car too long, or keeping a machine too long, is costing you money in both ways: higher maintenance bills and less sale value. And so you may decide, let's replace it every 2 years, you know, when the maintenance costs are still pretty low and we'll still get a reasonably high sale price for it. But the only problem there, of course, is you're having to pay out for the new one more often. So this is the sort of situation we're talking about, where, whether it's machines or cars, whatever it is, where we're going to need it effectively forever, so we are going to have to replace every so often. But how often should we replace? Should it be every 2 years? Should it be every 3 years? And so on. And so to explain how we approach the problem, can you look at exercise 2? A machine costs 72,000 and has a maximum life of 3 years. The running costs each year are as follows. First year 7,2, next year, second year 9,6, third year 12. So as I was saying, as it gets older, it costs more to run it. Similarly, the scrap values. If you sell it after 1 year, you'll get 24,000. After 2 years, you'll only get 16,600. Keep it 3 years, you only get 9,600. That's common sense. The sales value will fall as it gets older. Again, we assume we do need this machine effectively forever, so we are going to have to keep buying a new one. Should we replace it every 1 year, every 2 years, or every 3 years? Obviously, the maximum here is 3. But how often should we buy a new one? So that's the problem. There's no quick way. All we can do is cost out each alternative. 1 year, 2 year, 3 year. Cost out each alternative. Since we're looking primarily at costs here, see which is the cheapest. Now, because it is repetitive, I'll cost it out for replace every 2 years. And although, quite frankly, it's the same approach each time, although I will also cost out 1 year, 3 year, I do suggest, once you've seen what we do to cost out replacing every 2 years, I do suggest that you pause the lecture and calculate yourself what it will be if it's every 1 year, every 3 year. Anyway, there are 2 steps to it. Step 1, you calculate the present value of the first machine. So easy enough, and these would always be relatively simple, so we've no tax and inflation to worry about, even though all it would do would make it a bit longer, not harder. But the first machine, 0, 1, 2, remember I'm having a 2-year replacement. So what have we got? We've got the initial cost of 72,000. We've got the running costs in 1 year, 7,200. In 2 years, 9,600. At the end of 2 years, we would scrap it and say in 2 years' time, it's got a scrap value of 16,600. So the net flows 72 at time 0, 7,200 at time 1, and a net inflow of 7,000 at time 2. Now, presumably it's earning us money, but that's irrelevant because we always assume that it'll be earning the same money. However, often we replace it. And so all I'm concerned about is getting the cheapest cost. Well, there are the flows. Let's discount. The discount factor says the cost of capital is 15%. And so our discount factors, if I can find them, here we are. For 1 year, 0.870. For 2 years, 0.756. The present values. Oh dear, it can't be right. 7,200 times 0.87, 6,264. And then an inflow of 7,000 times 0.756, 5,292. So the overall present value, 72,000, 6,264, 5,292 is 72,972. Appreciate that is a cost. I've already said we're going to do it for all 3 choices and see which is the cheapest cost. But there is step 1. That first machine has a net present value of, a present value of 72,972. It's like paying out 72,000 now. But it's going to be repeated every 2 years. So, of course, at time 2, you would immediately buy a new one and all the flows will be repeated. And if it's exactly the same flows, then it's going to be like paying out 72,972 at time 2, at time 4, and so on, every 2 years forever. Well, the only problem is we can do the same shortly for replacing perhaps every 3 years. And if I just make up a figure, maybe every 3 years, it's like paying a present value of 80,000. But that would be 80,000 every 3 years forever. And we can't compare it with 72,000 every 2 years forever. They're not comparable. So to be able to compare, we have a second step. Step 2, we calculate what we call the equivalent annual cost. Now I'm going to write this here purely as a formula and then do the figures, and then I'll explain why. Because it's easy to explain why when we actually see the figures. For the equivalent annual cost, we take the present value of the first machine, which we've just calculated, and we divide by the annuity discount factor. for the replacement period. And let me show you what I mean. Now, the present value of the first machine we just calculated is 72,972. I'm not going to put brackets around it because we know it's a cost. We divide it by, well, the annuity discount factor of the replacement period. We're replacing every 2 years, so it's the 2-year annuity discount factor at the cost of capital, which for this question was 15%. 2 years at 15, the factor, if you check me, is 1.626, which gives 44,878. As I'm about to explain, that's equivalent annual cost. It'll be like paying out 44,878 per annum. Now, although our rules are ruling, in the middle of an exam, obviously you just do it. Just for a second, let me explain why. You see, I'm now saying it's like paying out 44,878 every year forever. Well, you see, if you look at the first two, 44,878 a year for 2 years is a little annuity. And the present value of those, you'd multiply by the 2-year annuity factor. It'd be 72,972 at time 0. You've then got the same flows again, 44,878, but instead of in 1 year, it's in 3 years. Instead of in 2 years, it's in 4 years. So exactly the same flows 2 years later. And if you multiplied again by the annuity factor, you'd get the same figure, but 2 years later. And so on and so on and so on. So 44,000 every year is equivalent to 72,972 every 2 years. And all I did was work backwards. But if we can do the same for a 1-year and 3-year replacement, well, if 3 years is, let's say, 40,000 a year, you can compare directly. Obviously, 40,000 a year is cheaper than 44,000 a year. So it's those 2 steps. The present value of the first machine, and then divide by the annuity factor to get the equivalent annual cost. Now, I said when I started this that it is repetitive. And so it's entirely up to you, obviously, but I really do suggest that you try 1-year and 3-year replacement yourself and pause the lecture, but then restart and check you got it right, or check with the back of the notes. If you're going to do that, well, whichever. I will carry on though, and I'll do it 3-year first and then 1 year. So let me go straight on if I do 3-year replacement. Step 1, the present value of the first machine, it's 3 years. So you've got the cost of 72,000. You've got the running costs of 7,296, 12,000. And you've got the sale proceeds. At the end of 3 years, we'll get 9,600. And sorry, those were outflows. So the net cash flows, 72,729,600 and 24. Discount at the cost of capital of 15%, 0.87, 0.756, 0.658, and the present values giving a total present value £87,101. That was step 1. Step 2, the equivalent annual cost. We take the present value of the first machine, 87,101. It's 3-year replacement, so divide by the 3-year annuity factor. 3 years at 15 is 2.283. And so this one is equivalent to £38,152 per annum forever. Have I got the right factor there incidentally? 2.283. Yes, I have. Sorry, I'm still a bit scared I'm leaving the wrong figure. Yeah, that is right. So before we compare and decide, we've done 2-year, 3-year. Finally, let's do 1-year replacement. Exactly the same idea. Present value, step 1, present value of the first cycle. The cost is 120. The running costs are 7,200. And the sale proceeds 24,000. So the net cash flow 120 at times 0. A net inflow 16,800 at time 1. The present values at 15%. I should have remembered this factor, 0.87. So the present value, sorry, that was the discount factor, I do apologise. The present value, 120,000. And an inflow of 14,616. I just realised what a stupid mistake I've made. I am sorry. The initial cost wasn't 120 at all. It was 72. I do apologise. You must have thought I'd gone mad. Sorry. Now I think I'm correct. An overall present value, 72,000 minus 14,616 is 57,384. That's step 1. For the last time, step 2, equivalent annual cost. 57,384, the present value of the first machine. Divide by the annuity factor, it's 1-year replacement, so the 1-year annuity factor at 15%, 0.870. And what do I get? 66,476 per annum forever. And now we've got it. It had to be one of the 3. Which of the 3 is it? 66, 38, 44. Remember, these are costs, and as costs, the cheaper the better. So which is the lower of the 3? It's 2-year replacement. No, sorry, it's 3-year replacement. There we are. There's the lowest of the 3. So it could have been any one of those 3 choices. In this particular case, we'll replace it every 3 years. All right, before I leave this lecture, you'll see below the exercise, it says qualitative factors in project selection. In fact, what's here doesn't relate purely to replacement, it relates really to any investment appraisal question. In all the exercises, whenever there's discounted cash flow involved, we are making our decision based purely on financial factors. In general terms, if the NPV is positive, accept, negative, reject. Here, slightly different, but the best cycle, the lowest present value of costs. However, we should consider what we call qualitative factors. There are plenty of other factors we should take into account which don't involve financial figures and which we're effectively ignoring when we make decisions based purely on present values. And you've got their examples. Compatibility with existing operations. How easy is it to fit in our new project? What about how the workforce are going to react? What about the quality of the product? What about warranties, service levels, reliability? As far as we can, we incorporate all the financial factors we know of. All right, they're all estimates, and that's another problem. But you can't ignore things like motivation of workforce, which will ultimately affect us, but normally things we can't actually measure. So that's just a sort of written part of it. We can only here make decisions based on the numbers, but just be aware that in real life there are these other factors you need to take into account. All right, there's one more thing in this chapter. I mentioned there are real options, which doesn't involve calculations, but again, I'd rather keep it separate, so it's a very quick one. We'll have one more lecture on this chapter.